There's thousands of different ways to analyze the markets. There's no one way to do it. There's hundreds of different indicators. There's all kinds of different structures and strategies and time frames, and everything is different for everybody. So when you're looking at technical analysis, you've got to also adapt technical analysis to your time frame. Day traders, you're going to use charts of 5 minutes or 15 minutes to day trade your positions. For longer term investors like me, I use daily and weekly charts because I'm not interested in about the day-to-day movements. It doesn't bother me at all that the markets broke the 50-day moving average yesterday. That doesn't change the dynamic of the markets, what I'm looking for long term. But those do kind of tell me about risk in the markets for the holdings and the amount of exposure I have. So maybe I adjust some exposure, but I'm not completely selling out of positions. I'm looking for a trend in the markets. Are markets trending higher or lower? If markets trending higher, I want to remain long exposure in my portfolio. So the last year or so, we've had a correction of some sorts. Back in April, the markets were down about 20%. And since then, the markets have been trending positively. So we have positively trending price action, and we know that the action is positively trending right now because the moving averages are all sloping upwards. So as long as those moving averages are sloping upwards, we're in a positively trending market. So I want to remain long equities. Yeah, are there going to be some wiggles and some bumps? Absolutely. But as long as the moving averages are trending positively, that keeps me long equities, at least in the portfolios for now. The reason that we use multiple moving averages is because they act as kind of support lines for the markets. What is a moving average? A moving average is simply the average price of the market, stock, whatever it is you're analyzing, over the course of the last certain number of periods. So 20 days, 50 days, 100 day, 200 day. Those tell me what the prices of the markets have averaged over the course of the last 200 days. And again, so we can kind of start to see that the market has been trending right along the 50 and the 20-day moving average. So as those moving averages have been rising, those have been acting as support for the market. So every time the market comes down, tests those support levels, we find buyers, they step in, and then markets continue to go higher. Now, for the first time here for a while, we've actually broken that 50-day moving average, which now buyers are probably somewhere around 6,500, around the 100-day moving average, which is kind of that next level of support for the markets. Now, there's lots of other ways to measure support levels, but again, just from a very basic view, I like moving averages for that. Two reasons. One, tells me what the average price has been, and two, tells me if the prices are trending positively or negatively. Back in April, when we started having this breakdown, we started seeing the moving averages turn negative. In other words, they started trending lower. This was a good reason why we started reducing exposure in the portfolio in mid-March. We started seeing that deterioration. We don't see that just yet, but if we start to see the 20 days start to turn lower, the 50 days start to level out, then yeah, we're going to start becoming more concerned about exposure in the portfolio.
Catch me daily on The Real Investment Show. The link is in the description.